Hi, everyone. Just wanted to give you a heads up that we'll be starting the webinar in the next few minutes. Thank you for your patience. Hey, Justin.
Hey, Manny, how's it going?
Good. How are you?
Pretty good.
Great to see you. Thank you for taking the time to, walk us through, what's going on in the crypto landscape, in particular with some of these tokens, blockchain in general, and really get your insight and expertise as Bitcoin and crypto have really matured as an asset class.
For sure. Thank you for having me. Pleasure to be here.
Yep, and for everyone, thank you for your patience. My name is Manny Frangidakis. I'm one of the co-founders of 12 Points Wealth Management, and I'm joined here with our good friend Justin Holmes from Fidelity. So Justin, I don't know if you want to give a quick background on yourself and your experience in the industry.
For sure. Yeah. So my name is Justin. I am a business analyst at Fidelity Labs, working at a crypto startup. I've been in crypto for more or less 8 years, and I've seen the industry really evolve and mature. So it's been nice to see where things stand today. I was a former founder, very much in product development and prototyping. I think one of the first projects that we built was in supply chain, I think in early 2017, and have since gone on to build a bunch of different projects.
Fascinating. Well, again, appreciate you being here, and we're all looking forward to learning more from you as it relates to cryptocurrency. So, just a little picture here of Justin as we get going. Um, Bitcoin 2009, obviously a lot has changed since then. But, very much interested. I know it's top of mind for a lot of people regarding, hey, what is crypto? How do we get involved with crypto? Where do we see the opportunity? So I'm just going to jump in with maybe just some foundational questions. Think of it as more of like crypto 101, but in like the simplest terms, Justin, what is cryptocurrency and why does it exist?
So I think it's important to kind of separate cryptocurrency from Bitcoin, because Bitcoin was pretty much the first innovation where this entire ecosystem came to be. And so you have Bitcoin, which effectively is a digital currency and a network, and everything else you can kind of look at it as crypto assets. And we can get into later when we talk about Ethereum what that means, kind of broadly speaking. But in its basic form, it's internet money, data. It can be a lot of different things. So it's a pretty broad term. You've also heard the term digital assets, which is kind of interchangeable with cryptocurrency. And those can be anything from a digital version of a dollar or a stock or a bond, or a piece of artwork, a deed. But in this case, with respect to Bitcoin, we're just talking about digital money, or better, less digital gold.
Yeah, and so since you brought that up, how would you look at cryptocurrency differently from traditional money or investments like stocks and bonds?
Yeah, great question. So I think the basics of Bitcoin are such that it because it's a hard cap of 21 million, it functions as more or less a digital gold, and it's not the best form of money given its volatility and its slowness. So if I wanted to go pay for a coffee with Bitcoin, it wouldn't make a lot of sense. But if you want to use it as a store of value, then it does. And then we kind of get into other versions of cryptocurrencies like stable coins, which are more or less a digital dollar, and they're meant to remain as such, just a dollar. And those are more efficient to be used as a digital form of money. So again, it really just depends on how you look at the industry as a whole. And if you are just looking at Bitcoin, we're looking at it as more or less a store of value that does have a lot of volatility and a lot of price swings, but for the use of the technology, it's really good as a store of value long term.
Fascinating, fascinating. So obviously there's, you know, the market has drastically grown, and as you can see in terms of its market cap, where kind of Bitcoin stands today compared to some of the more well-known brands across the globe. So it's certainly matured as an asset class and is becoming more widely adopted. But there's so much jargon as it relates to the industry and words that get tossed around, and I know it can be confusing for a lot of folks. So, you know, when you think of, you know, blockchain technology, you know, why is it important to the world of crypto? Because, you know, those are the two words you hear the most, right? Crypto and blockchain.
Yeah. So if we just take a huge step back and we look at Bitcoin in relation to gold, if we were to find more gold off of this planet, let's say on some form of, you know, space rock, gold doesn't necessarily have a finite supply. So Bitcoin is hard programmed to only have 21 million, each divisible by 100 million units. So you can go and buy $10 worth of one Bitcoin, even though I think what Bitcoin's worth approximately like $113,000 today. So you can buy $10 worth of a Bitcoin and you're going to get 0.00 whatever that number is in dollar value. And so because there's only 21 million Bitcoin, you have this very, very scarce supply. So you can kind of relate it to that of gold's overall market cap. And you might hear a lot of, you know, analysts say that Bitcoin has the potential to be worth as much as gold, and that's really due to its scarcity. So if you're looking at the $2.3 trillion in the comparison to the $22 trillion, that's where the analysts of this industry are really trying to make a prediction of where Bitcoin is going to be in the future. But as it relates to its the management of those 21 million Bitcoin, blockchain is the fabric, the foundation by which you can keep a record of account of all Bitcoin transactions. So you can see where all of the 21 million, let's say 20 million, because there's, let's say about 5% of unmined Bitcoin, and we can get later into what that means, but you have about 95% of the 21 million Bitcoin available for buying, selling, trading, etc. And all of that can be viewed on the blockchain. And the blockchain is important because it holds a record of truth dating back to 2009. And that record of truth will never change. And that's what makes this entire thing so special. And I believe what inherently gives it its value.
I would agree. Obviously, the world of crypto has drastically changed since the likes of just the Bitcoin and Ethereum, which were probably the first two to come to market. But now it seems like there's thousands of cryptocurrencies out there. You know, how should someone think about Bitcoin and Ethereum compared to the rest?
So Bitcoin is really good at doing one basic thing, and that's just as a store of value. Again, it's not really meant to be an efficient form of currency. Now, that could potentially change with new innovations that are on the horizon, making it more making it faster to transact. But Ethereum was the innovation that really ignited cryptocurrencies in the way that we understand it today, where you have a flood of tokens. Ethereum is really good at allowing developers to build applications and issue assets. And those assets can be very, very broad, from an audio file to an NFT, which is just, you know, imagine you take a picture and that picture lives on your phone and you are the only person that has that one picture in that one moment in time. But the moment you share it to your friends and they share it to their friends, you're creating multiple copies and there's not a source of truth. The blockchain registers a, let's say for simplistic sake, a picture, and that picture lives as an asset on the Ethereum blockchain, not on the Bitcoin blockchain. There's two separate blockchains. And you could effectively create a tokenized version of that picture and sell it, fractionalize it, and that would be an NFT. And so we're starting to see these innovations proliferate beyond just an NFT to the digital dollars, audio files, etc. And there are some more forward-thinking projects that are even putting biometric data on blockchains as well. And it kind of, as you start to see it evolve, we're starting to see that it's functioning more like an internet than it is anything else.
Like the internet, that's fascinating. I could see it, how, that web can just spread and spread and spread, and, that truth factor of that blockchain, I guess, holds it all together. But what do you think are some of the biggest myths or misconceptions you hear about crypto?
The biggest myth is that these assets do not have revenues or proper financial statements. There is a really good website that I love to use. It's called Token Terminal. And you can go in and you can look at all of the different revenues generated from these protocols, and we can define protocols as applications or businesses that are built on top of these networks like Bitcoin or Ethereum. And just to give you a sense of some numbers, I believe in the last quarter, one of the decentralized exchanges that allows anybody to do trading without needing to KYC or upload your ID in order to trade. It generated, I think, upwards of $100 billion, if I'm not mistaken. And so it's hard to imagine that these things actually do generate revenue, but the deeper that you get into the protocols, you'll see that they're generating substantial revenue that's comparable to our more traditional businesses that we're accustomed to, looking at financial statements for.
Interesting. So since you brought up platforms and that website you just listed, how are people, and there's been a ton of companies that have either adopted or changed their platform, and, Circle and Robinhood come to mind, but how do people actually buy, sell, and store crypto safely?
So you could use a exchange like Coinbase or Kraken, Gemini. There are a bunch of exchanges depending on where you are geographically, or you can use some of the native protocols like Uniswap, and there are tons of other exchanges. And over time, it's become easier to have on and off ramps where you can just add your debit credit card, and you can just buy the coins directly within a wallet. And a wallet is just an account for simplistic purposes. It's a blockchain registered account, and that's separate from the account that you would interact with on let's say a Coinbase. And so there's two different ways to just buy them and then use them. You cannot really use the assets in the same way that you like on an exchange that you can within a wallet, and we can get into that later. But once you get into the wallet territory, that's where you are fully responsible for your assets. And there is a term in crypto called not your keys, not your coins. And the keys is just another fancy name for a password. And so, but you hold the password and you never share the password. If your password gets compromised, there is no one who you can phone up and you can get your assets back. So it becomes your responsibility to keep them safe. And that is a self-custody model. And there are many different ways that you can go about keeping the keys safe, which again, we can get into at a later time.
And is that the same for, and maybe you can give us a little bit of a definition, but is that the same process whether the exchange is centralized or decentralized?
Yeah, so centralized would be Coinbase, and then decentralized would be any of the protocols, applications, or businesses that are built on top of these networks like Ethereum or on top of Bitcoin. And the main, I guess, high level difference is you'll have a traditional like corporate structure for, let's say like Coinbase or any of these centralized exchanges. And then in a decentralized exchange, it's more or less the holders of the tokens of that protocol are able to cast votes over what happens to the protocol itself. And again, I'm using protocol and business interchangeably on top of these networks. So if you hold, let's say, Uniswap tokens, you become a token or you become a voter over what happens to the protocol. If there needs to be a software upgrade, if you want to change the fee structure. By holding the tokens, you can then cast votes. And so there's a lot of different utility behind some of these tokens. And therefore, the incentive structure and the corporate structure, I guess, are, very, very different.
So, but it's not too differently than, being an equity investor and owning, a share of a stock where you then get proxy votes to be able to put your opinion forward as a shareholder. Is that accurate?
That is super accurate. The only nuanced difference is that you may not ever see their face, or you may not know who is on the other side of the vote. And that becomes a little, different. I mean, sure, that is more akin to, traditional models as well, but it's global, and, it could be somebody from the most remote part of the world that has access to the internet, and they've never had access to participate in some type of governance structure, let's say for any company in the S&P. So it definitely distributes the ability for anyone to participate.
Interesting. Yeah, and you brought up Coinbase, and looking at this slide in particular, we can see how public companies are holding Bitcoin at this point in time, and more so the adoption in terms of the corporate sector with crypto and Bitcoin as asset classes and store of value and a position on their balance sheets. I'd love to hear your perspective with looking at these names and how the industry has grown. How do you interpret this?
So I think this is more or less due to some companies taking the risk, jumping the gun before regulation hits and makes sense. And some are now, being a little bit more proactive, given that regulation is starting to become clearer, which allows for innovation to flourish. And I think it's just a testament to the belief in the overall industry, starting with Bitcoin because it's the easiest thing to understand. But as you'll see, that there are other assets that are being adopted as a reserve asset class for a lot of these companies, both public, private, and government. And the fact that they're holding it for the long term signals their strength in the belief in the system. And so I think it's a positive sign in the right direction. At first, it was very retail focused, and now to see institutional adoption is it's nice.
Definitely shows the maturity taking place in the industry. And then, obviously we're seeing it from public companies, but, obviously on the private side as well. So I would imagine it's the same story.
Yep, correct.
And then what about, governments? Because now we're starting to see, potential sovereign nations that are utilizing Bitcoin.
Yeah, I mean, I can't speak too much to like what governments will be doing or how they're thinking about it, but again, it does signal confidence in the overall industry, specifically with Bitcoin. You look at U.S. leading with nearly 200,000 Bitcoin on their balance sheet. Whether or not they're going to continue adding to the strategic Bitcoin or crypto stockpile, TBD on that. But again, this is a sign of confidence as to where the industry is headed, and it's a sign for innovation. And I think that to me is more exciting, because the things that you can do on top of these networks are mind-blowing.
And so with the confidence that is being, generated in the industry based off of what we just described and talked about, if someone wanted to start dipping their toe in today in terms of crypto, what are the first three things they should know or do?
Understand the nuances between buying on an exchange and buying on a decentralized exchange. I think the easiest gateway is to go into an exchange and then use the assets. The easiest way to understand crypto is to use it. It's not to, it's an easier conversation to say, hey, invest into these things, but that's not what at least my focus is, and not what I really want to teach. What I really love teaching is how to use the assets. And the moment that you use the assets in the way that they were intended to be used, things start to click. You start to understand why Bitcoin is not a good form of money, because the moment that you send it to a self-custody wallet and you move it to a different self-custody wallet, and you see that it takes more or less 10 minutes to move, it's super slow. It's inefficient. We like things fast. Then you do the same thing with Ethereum. You just move it from one wallet to the next, or you use an exchange or some type of application, and you'll realize that you cannot use that application without having a little bit of ether. So for example, I'm going to abstract this big time, but let's just say we wanted to have a carbon copy of Instagram on Ethereum. If you wanted to upload a picture that would cost a little bit of ether to publish to the Ethereum blockchain. If you wanted to like a picture, every interaction is a transaction, and every transaction costs money. And in this case, it costs ether. And so if you want to use these applications, you're going to need a little bit of ether. And so that's what I would say. Start using these applications. You don't need a lot of the asset to play around in this space, but use the applications to understand how crypto works, and things I believe will start to make sense.
Fascinating. So, just following along here. So Bitcoin, the world's most trusted software for storing and moving value on the internet, kind of just what you just described. Tell us exactly what we're looking at here.
You're looking at these are basically instructions for like a super simplified version of the instructions for how to run the Bitcoin network and how it all kind of works holistically. So you're just looking at the, I guess the Merkle trees, which are effectively, without getting too technical, you're just looking at the way in which blocks are produced on the network, and a block can be defined as a receipt that has a list of transactions. And the transaction could be Justin moving Bitcoin from his wallet to Manny's wallet. That's going to show up as a transaction that gets pressed into a container or a block. And once that block gets filled, or enough time has passed, it gets published indefinitely in the blockchain, and then it creates another block of transactions, so on and so forth. So these are just a set of instructions to run the entire network. And there are there's a whole white paper that you can look at, but this is just a super simple snapshot. And just to simplify that, Bitcoin is just software. And if we start looking at it as software, and we eliminate the jargon of it being an asset class, and we understand what the software is intended to do, then I think things can be a little bit more digestible.
Yeah. So we, just talked about it, looking at it software, but for most people, it's still a digital currency, and a system to manage it is what you, utilize the blockchain for. So, I would imagine if you're looking to get involved in crypto and you're either mining or whatever, you're going to need some network participation. And I think that's what we're looking at here. Specialized computers to help you with the mining. It's obviously heavy in terms of its use of the internet and electricity and power, and then your own version of a crypto wallet.
Correct. Yeah. If you wanted to be involved in running the infrastructure or running the blockchain, you would need a specialized computer, like ASICs miner. It's very, very computational intensive. So you're going to need access to an abundance of electricity, preferably super cheap electricity, internet 24/7. The network can never go down. And you're going to need a Bitcoin wallet. Again, a Bitcoin wallet, or any wallet, is just an account, and it's where all of the assets get stored. So that would be kind of the prerequisites if you wanted to get involved in mining, specifically for Bitcoin. And if you go to the next slide, you'll see that Bitcoin network as a whole is operated by a global set of independent large-scale data centers. And we're talking about a really, really big operation. And it becomes increasingly more expensive and harder to process transactions as time goes on. In 2009, it was much easier. You could set up a computer in your living room and you can mine Bitcoin. But the more computers that join a network, it becomes a little bit more challenging to participate and make a profit. And so the larger the data center is with the specialized hardware, the more of an opportunity you have to earn new Bitcoin out of that 21 million that we discussed earlier.
And then, so going into, further into mining, the capabilities, what is required, you gave some quick background there in terms of, what hardware you would need and, electricity demand. But for someone being a beginner, I've never done any Bitcoin mining, how does it work?
Yeah, so I wouldn't recommend doing Bitcoin mining. This is just to give anybody the overview of if they wanted to and they had the resources to do it. You can definitely look into it. Please do your homework. But to understand what you're looking at, blockchain is a very much conceptual term. This is a really good user interface to understand visually what a blockchain is. So if you look at the top row, you'll see that these are images or representations of the blocks in the chain of blocks. And below, you'll see the number block that is. And you can go back in history to 2009 to see all the blocks that have ever been created, and therefore all of the transactions, because it lives forever. And if you look at the first row or the second row, where it says, I believe it says 909,643, that's the number of block, and you can see the unique identifier for that specific block. The miner in this case would be unknown, so they chose for whatever reason not to publish the name of the mining facility or the data center. You can see the time that it was mined. You could see the number of transactions. You could see the size of the transactions, and then you can see the fees associated with all of the transactions. So for a reward or for compensation of running that data center, you are getting, as a miner, you are getting newly minted Bitcoin. I believe in today's rate, it's 3.25 Bitcoin every 10 minutes. And that 3.25 Bitcoin reduces by half every 4 years. And the next time that it will cut in half is the year 2028. And so every 4 years thereafter, it reduces in half. And so the idea is that because there's less of a reward, by the time that reward drops, the value per coin will go up. So conceptually, that is the way that it's designed, and that's what gives people confidence in overall mining and maintaining the network. There are a lot of, I guess, concerns about what happens after, there's no longer any coins to mine, what then happens. So these are all things to consider, in terms of risks and whatnot. But this is just a visual representation of what a blockchain is. And if you're ever curious and you want to do your own analyst, if you want to analyze a blockchain, you can go look at a Bitcoin block explorer and you can go look at all of this yourself.
And so before we jump into Ethereum, since you just brought it up, in terms of, the volatility facing the asset class, or if you've looked at crypto as an asset class, the volatility there is obviously, both upside and downside has been pretty violent. What are the major risks of owning crypto beyond volatility?
You have a lot of, technical risks and human error. So if you're going to use any of the applications, sometimes you'll have applications that have poor code, and so the code can fail. It could be malicious code where it's more or less a hack. And if, let's say, in order to use these applications, it's a URL or a website, and it's always good practice to check to make sure that that website is accurate. Sometimes in even like a Google search, like you'll search, let's say Uniswap, because that's just the easiest one to understand right now. Look at the end, make sure it's like a .org. I totally forget what exactly the URL is, but just make sure it's the right one, because if it's the wrong one and you sign into that website, all of the funds within your self-custody wallet could be drained. So there are a lot of risks in that regard. So you just want to make sure that you're navigating the space appropriately. But I'm hopeful that as these problems are super, super common, if we're going to onboard more people into the ecosystem, a lot of the innovation has to catch up with reality, and hopefully there's proper guardrails in place going forward.
Yeah. Kind of like the Wild Wild West, but like anything that people should be aware of as it relates to scams or losing out on their wallets, besides just losing their password.
Yeah, so there's also that too, scams. You could buy into an NFT project and that doesn't work, but it's no different than in some respect venture investing into a startup, right? If the startup fails to find product market fit, then is that a scam, or is that just a poorly executed business plan? So it's a fine line, but there are a lot of risks participating in this space. But one thing is for certain, that is you can trust the blockchain. So if you are using it as a form of currency or a store of value in some respect, the blockchains themselves have never been hacked. It's the businesses that are built on top of it and the wallets that connect to those businesses or protocols or apps that is usually where a lot of the hacks happen.
Yeah, that makes sense. So, looking at Ethereum right now, and I know you gave us some quick background, but besides, the creativity and it being used more as an application and something to build upon. Is there any other major differences that you would point out as relates to Ethereum compared to Bitcoin?
There are a lot of differences. Ethereum used to operate similar to Bitcoin with respect to mining. Same big, large data centers, but now it's shifted to a more energy efficient, lower hardware requirement network. So it's just far more efficient. You can kind of think about it in terms of like having a gas powered car or an EV. One, runs, can go for, long distances on gas, and one can go for longish distances on electric. But it's just far more, energy efficient, and, so on and so forth. So there's that, but the biggest piece of innovation is the fact that you can build things on top of it. And that's where I think, Ethereum, in my opinion, is just more interesting because of all of the different use cases.
Mm-hmm. So looking at this list of corporations and governments that are now holding Ethereum, is it your opinion that essentially they're using Ethereum to build upon those applications?
So yeah, so if you look at the excitement and regulation and talk around stablecoins, most, if not all, I wouldn't say all, but most stablecoins are built on top of Ethereum. And if you remember back to my Instagram example, if you want to upload a picture, you need a little bit of ETH. If you want to like a picture, you need a little bit of ETH. If you want to move a stable coin, you need a little bit of ETH. So if your business is built on top of Ethereum, you're going to need a little bit of ETH to power your own business. So one can only imagine that there are business opportunities at play, or they could just be using it for a strategic reserve similar to Bitcoin in a different form of, store of value in some respect, because you're seeing the potential business use cases with Ethereum. So I have no idea what each one of these are thinking in terms of their strategy. But again, Ethereum unlocks new business opportunities that Bitcoin just does not.
Understood. So yeah, I would just read this as, again, further adoption regarding the industry.
Yeah.
And then so, Ethereum, the most trusted software for building blockchain and app issues and assets. Is this what we were just looking at as it relates to the previous slide that depicted Bitcoin?
Correct. So Bitcoin has a white paper, which is a set of instructions to run and power the Bitcoin network. Ethereum also has a white paper with a set of instructions to build and power the Ethereum network. This is just a super simplified snapshot of a code snippet from Ethereum showing how you could send and receive transactions and kind of what that would look like from a blockchain and programmatic standpoint.
Fascinating. And then so, we just talked about some of these, different platforms that have now come to market related to crypto. You mentioned Uniswap. We could see that in the, bottom right. Kraken, I think we haven't mentioned yet, but these are essentially applications that anyone can build.
Yes, so you'll have centralized exchanges, and I believe, so this website, blanking on the actual website, but I can get it to anybody who needs it, is showing that there are roughly about 1,300 apps that are built on top of Ethereum. I don't think that captures all of them, to be completely honest, but you'll have exchanges that are using or operating on the Ethereum network. Then you'll have the decentralized exchanges, apps, protocols, businesses that are also built on top of Ethereum as well. And so if you look to the left-hand column, the filter by, you can see crypto wallets, tooling, analytics platforms like, let's say, Token Terminal. If you want to look at the P&Ls or the financials for all of these assets, you can. You can look at the, the governance or DAOs. These are basically like, think about it like LegalZoom, or a way that you can spin up an LLC or like an S corp of some capacity, but you can issue out, tokens, voting rights, etc. So there's a bunch of different possibilities in terms of applications that you can build, including gaming and metaverses and all the good stuff. So it's not just a one-size-fits-all ecosystem. It's not just about decentralized finances or trading. it goes much, much broader than that.
And then a question that I just actually, popped into my mind just now, prior to, what we've experienced in the markets over the last, call it, 2 years with the rise of NVIDIA and everything, a lot of, the talk on Wall Street was blockchain and crypto and whatnot. It seems, AI is now that new hot, fad or theme. How does blockchain or crypto or AI, where do they meet? Where is there a benefit? Where is there a risk? Is there any insight on that?
Totally. So in one respect, so Ethereum is big innovation, which is in the next slide, talks about smart contracts. And smart contracts are not really smart. They're kind of dumb. It's just you give it instructions, you press enter or send, and once you press send, it will just run automatically. There's no reversing it. It just will go. But if you wanted to give it complex rules to do this, do that, then do this, and then do that, and make it conditional, and you wanted to ask ChatGPT to facilitate the movement of the assets, the blockchain becomes this medium by which you can audit the interactions of what an AI is doing with the assets. Something that is hard to do with traditional assets. You can give a ChatGPT your bank card right now, but with guardrails. But with crypto, it becomes limitless and it becomes auditable and transparent. So you have visibility into what it's doing. So you're effectively, and I know this is probably going to not be 100% accurate, but to summarize it the best way that I can, you cannot make ChatGPT an authorized user on your credit card. Maybe you can, but it'd be hard. But you can make it an authorized user of your wallet. And so I think that will probably be the first entry point. Now we are seeing newer innovations emerge where, if you're familiar with Replit, which is an agent that allows you to build websites or apps. If you didn't have the coding skills to build a smart contract, and smart contract is an app business protocol runs on a blockchain, you can say, hey AI, build me this decentralized exchange using the verified Uniswap code, enter, and then you just create your own environment. And then if you have the assets, you become the LP in that exchange, and then you can then get other people to participate in your new business venture. So there's a lot of different things that can emerge from with AI, but it's it's a super interesting space.
Yeah, it's definitely all the rage today. And similar, with Ethereum, as we talked about with Bitcoin, there's prerequisites and network participation that is required.
Yeah, and with Ethereum, it's pretty similar. You need a generalized computer. It's not going to be this specialized ASICs computer. You still need internet. You still need electricity. You need an Ethereum wallet, not a Bitcoin wallet. And if you are going to be participating in the validation or the mining of new Ether or validating the transactions, you need a minimum of 32 Ether, which I believe is valued today around $4,000 per ETH. So as ETH becomes more expensive, that 32 or your ability to run a validator node on the Ethereum blockchain becomes more expensive.
And that's exactly what you're talking about here.
Yeah, so you could, if you had 32 Ether today and you wanted to participate in validation, which is just validating all the transactions, if you had a gaming computer at home or some computer with certain specs, you can look at the Ethereum white paper and see what those specs are to run the network. You would need 32 ETH, and you can just do that right from your house, and you can participate in validation. Or you can have a small scale server facility and do the same thing. This makes it more attainable for anybody to participate in the network, unlike Bitcoin.
So, and then this is that transaction report, right? Where you could see when something was mined or created, or an application was created, and then that timestamp, lives in perpetuity, in theory, forever.
Correct. So like on the right side, you could see the from would be, let's say, Manny, and then the to would be Justin. But on the blockchain, there's no notion of identity. You don't know who that address belongs to. but you are able to see all of the activity from each one of those addresses. So in theory, if I knew, and this is one of the problems with crypto, but in theory, if I knew what your address was, Manny, I would know your entire net worth as associated with that one wallet. That's something that doesn't exist today. If I pay with my Venmo account or my debit or credit card, you don't know what my net worth is or how much money I have in that account.
Mm-hmm.
Privacy is not a core feature of blockchains. Security is. And so privacy is newer innovations that are emerging, which is, another reason why I think it's taking a lot longer for wide scale adoption, because it is rather important.
Yeah. So you're giving up, your privacy for security.
In some respect, but there's no KYC with any of these wallets. So it becomes, yeah.
So this is an interesting slide and something that I was not really familiar with. So if you could just give us a brief background and explanation between, self-custody, and you can see some of the brands that are down there compared to using custodial, which are, the likes of, you see Fidelity up there, but Coinbase obviously is a name that I think most people are familiar with. What is the difference? How does it work? How are investors choosing to look at custodying their asset?
If you do not want your assets on an exchange where you do the trading and you just want to set it and forget it, then you're probably going to go with a custodian. So that would be like Kraken, Coinbase, Binance, Fidelity, Anchorage, etc., BitGo. Now, as you'll notice, Coinbase is also an exchange, but they also have a separate business, which is just custodial business. And what that really means is they manage your keys. So going back to the phrase, not your keys, not your coins, they manage the keys on behalf of you. And it makes it a lot easier if you have large holdings, if you want to have an advisor have access or visibility, or if you want to do things like put it in a will or whatever it may be. It's a lot easier when it's in a custodial account versus self-custody. With self-custody, you are in full control of those assets. If something were to happen to you and nobody knew where your keys were, those assets are gone. So there's a inherent trade-off. But when you're using a self-custody wallet like MetaMask or Coinbase wallet, Coinbase has multiple products, you're able to use the applications, the decentralized applications, all of those apps that we talked about. It becomes a little bit harder to use them in a custodial wallet, but a custodial wallet is really there for security. And we're starting to see more and more institutions get involved in custodying these assets. And it's, that's a testament to this institutional adoption. But that's just kind of the two nuanced differences. Not your keys, not your coins. You give up the keys to the custodian, but it comes at the trade-off of you being in full control, or you entrusting another institution with those assets, so that if something ever happened, there's safeguards.
Yeah, that makes sense. So really, I would understand it as depending on your objectives, your strategy, how you're planning to use the asset really determines whether you want to go a self-custody or custodial route.
For sure, yeah. You could, let's say you could take as a strategy, you could take a percentage and put it in, with a custodian, and you could take a small percentage and use the applications, and then put them back with the custody. It's kind of like, a bank for all simplistic purposes. So yeah.
And is that, so that's a great segue kind of into one of the last things that we'll be talking about is how do you move things between Exchange Wallet and DEX and, Uniswap demo at this break here. So I'd love for you to take us through this and really show, the listening audience how you can, move between platforms.
Yeah, so I think, am I able to share the screen or no? Because if not, then we'll skip the demo. I can talk about it, and for anyone who's interested, we can kind of do a one-off here. But if I'm able to, then I can show you.
Yeah, I would just talk about it.
Talk about it. Perfect. Yeah. So essentially, if you go back up, I believe it's uniswap.org. If you go to uniswap.org, you'll be able to see this is a launch app, and when you launch the app, it will connect to your web wallet. And the web wallet will authenticate you into that to that DApp or the exchange, and you'll be able to make trades there. When you look at the spread on Uniswap, and DEX stands for decentralized exchange, and CEX stands for centralized exchange. And when you look at the spread on Uniswap, it is, I believe, anywhere between 2 to 4 times cheaper than trading directly on Coinbase, the Coinbase exchange. Coinbase Pro, which is more advanced trading, is a little bit more comparable, but pound for pound, using a DEX is significantly more, it's just more efficient. With that wallet connection into Uniswap, if you keep it connected, that runs the risk of of anything going wrong. So it's always good practice to disconnect from the application itself. By disconnecting, it's your wallet into the exchange. So disconnect it, keep everything safe. And when you look at the revenues, I think we talked about this earlier, you can see that in the past, let's say, call it quarter or so, we're looking at about, just a little over $100 billion in trading volume on this protocol. And that's just one of many protocols. And a lot of the other decentralized exchanges have been carbon copied code from Uniswap. So you'll notice that there's a lot of different names for decentralized exchanges. A lot of it's just reused code to create the same business, just structured in a completely different way. But this is just a testament to some of the activity that's going on across these networks, particularly with Uniswap. And so, yeah, if you ever want to verify this, you can go to DeFi Llama, which is an analytics platform, or you can go to Token Terminal. You can look at the revenue that's generated by Uniswap.
Awesome. So that kind of takes us through the deck, but I would love to wrap up with some questions that I have. So, beyond investing, where is crypto actually being used in the real world, and how do you see it evolving? Whether it's the future of finance, payments, everyday life. And one of the other things that's notable is the change in the administration and its views on crypto, and whether that's the presidential administration and those folks that are in the White House right now, but also the change with the SEC.
Yeah, so I would say that regulation equals clarity, and clarity is good for innovation. And I think the innovation is needed. For example, the privacy stuff. There is a really technical term called zero knowledge proofs. And essentially what zero knowledge proofs are is if you go to the bar and they ask for your ID, all they want to know is, are you 21, yes or no? And so it's really the yes or no. Are you approved, yes or no, without revealing your birth date, your address, and all of the other sub information. And so a lot of these innovations can now be used. So I think regulation will allow for these things, because it's not the most effective in comforting to use stable coins as a form of payment if everyone can trace back to your wallet and know everything that you're doing and your total net worth. So regulation equals clarity, clarity equals innovation, and innovation will allow for things that will allow the masses to be onboarded in the crypto.
Mm-hmm. Okay. All right. I know we're running up against the clock, but I do have one final question. And Justin, thank you for spending the time with us and showing us and explaining to us all the different ways to look at crypto. From your professional opinion, you're in this every day. If you had to predict, what does the crypto landscape look like over the next 10 years?
I would say our operating systems on our phones and our computers will probably be some form, be built on some type of crypto network. Our phones will effectively have wallets. Right now, you can use Apple Pay if you have an Apple phone. And then the intelligence within our phones will be able to access these networks. So right now we'll go to Safari, we'll go to Google Chrome, or go to any one of these web browsers, and you have this dual world, one that's crypto and one that's not. I think there will be a blend, and there might be one day where you open up your bank account and you'll see a section that says crypto, or you might get issued a credit card, and instead of it being a virtual credit card, it's actually stable coins, but the UI looks like a credit card. So I think we're going to start to see the blending of these traditional finance and crypto together, and you won't even know that you're using it. And I think that would be the perfect harmony and the perfect outcome.
Fascinating. Yeah, I agree. I think you're just going to continue to see this industry evolve and adapt. To your point, whether it's regulation or technological adoption and advancement, I think there's a whole slew of ways that this could play out, but obviously it's top of mind for a lot of investors, a lot of entrepreneurs, and people as they navigate to this new digital economy. Justin, thank you so much for joining us. Really appreciate the time. Thank you to the listening audience for joining us, taking time out of your busy days. This webinar was recorded, so if you would like a copy of this webinar, Justin's deck, or to get in contact with Justin, please reach out to us here at 12 Points and we will connect you and provide all materials. Thank you so much. Justin, any closing words on your end?
Nope. Thank you for having me. Really enjoyed it, and yeah, happy to assist where I can. So thanks.
Awesome. Thank you, everyone. Wishing you guys a great rest of your day and remainder of your week.
Bye.